Good morning, everyone. Tim Nyland here. Today is Wednesday, April 28th, and this is our weekly strategy call for Zacks Professional Services, where we analyze stocks, question the typical narratives, and discuss all things moving the market. Before we get started, be sure to hit the subscribe button and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you have a topic you'd like me to discuss in a future video, leave a comment below. And if you find this video useful, be sure to hit that like button. This week, we're going to talk about the airline industry. And specifically, we're going to take a look at what has been called a financial recovery in the works, and specifically been seeing a lot more in the press about the airlines and the fact that the finances are starting to improve. This was an article out of the Wall Street Journal that appeared on Friday of last week. It was actually the cover story in the business and finance section. And obviously, I read the article, and there's probably 80% of the story that's in fact missing. And even though we're starting to make a little bit of a turn, you're going to want to take this particular article with a grain of salt as we explore the real financial issues facing airlines. This rebound, as the caption on the slide suggests, is really like none other that the airlines have faced. And this is something that I've been alluding to for the past 9 months related to airlines. And now that most of them have reported their third quarter, we can dive into the financials a little bit more, and I'll show you exactly what I'm talking about. So the real key here is up in the upper left where it says Southwest American recall flight attendants, pilots in anticipation of increased leisure travel. So we're going to take a look at a couple themes in addition to the finances and what's going on with the airlines, but we really need to focus on 3 stages of airline recovery as well. These are ones that you're very knowledgeable of. It's obviously leisure, that would be business travel, as well as international travel, and that recovery can really happen in any order. So let's go ahead and get started. The elephant in the room that I've been talking about for literally 9 months is the amount of debt that the airlines have taken on. And now that third quarter has reported for the majority of these companies, I can show you exactly now what I'm talking about. And what I want you to take a look at, and you can do this in the Zacks Advisor Tools system as well. As a matter of fact, I'm going to have some Advisor Tools charts sprinkled into this particular webinar. But for this particular chart, I'm just using the research system chart. And what I'm showing here is total debt. So that's going to be long-term debt, obviously, plus current debt. And what you're seeing is the Great Recession period here and the amount of debt that American Airlines, obviously, all industries got decimated in the Great Recession, and we thought that was bad. And you can see the total debt load for American coming out of the Great Recession. And you can see that since then, American's debt load, specifically outside of the COVID crisis here, has literally tripled since the great financial crisis. And the idea here is that despite the fact that we've got a recovery in leisure travel that's being forecasted, it's still very, very much so unknown as to whether business and international travel, if and when that recovery is actually going to take place. So we need to keep this in mind as we look across what I'm calling the big 4 airlines. So I got American. The next one we'll look at is Delta. And again, if we look at great financial crisis levels here of total debt load relative to where we are now post-COVID, you can see that for Delta Airlines, we're literally 2 times the amount of total debt. And again, that business and international travel recovery is still in doubt. Southwest Airlines, again, taking on a lot of debt here to get out of the Great Recession. And you can see that debt load leveled off. And then obviously with the COVID crisis now, we're looking at debt levels that are 3 times that of the great financial crisis. And when we look at United Airlines, it's a similar scenario. United's actually taken on 4 times the amount of debt as the great financial crisis. And keep in mind, again, business international travel recovery still in doubt. And you can see this massive spike here. So we're going to switch over to an Advisor Tools chart right now. Advisor Tools does a really, really nice job of outlining this particular series. We've got obviously all of the same valuation and fundamental ratio series in Advisor Tools as we do the research system. So I went ahead and just put together a 4-stock chart of total debt in Advisor Tools. Very, very easy to do. And you can see the exact same scenario here. So again, overall COVID debt levels nearly 4 times that of the great financial crisis, anywhere between 2 and 4. And again, that business and international travel recovery is still in doubt. And this is one thing that Wall Street Journal article didn't make one mention of. They talked about a recovery in the finances of these airline industry, or the airline industry as an aggregate, and they failed to talk about the total debt load. And this is significant. Nobody's talking about this now, but they will be. And so I went ahead and created a composite of the big 4 airlines in the research system. And in aggregate, we're looking at COVID debt levels nearly 3 times that of the great financial crisis. And you can see what that trend looks like. So again, this is just a bottom-up, equal weighted composite of the big 4 stocks that we just looked at. And the idea that I want everybody to see here is in aggregate, they're actually still taking on debt as of Q1 of this year. So the debt is definitely not going down. It's actually continuing to go up. And if we look at the financial statements, you can actually see what that looks like. It's a quarter-to-quarter 2.7% increase versus the fourth quarter, the 12/31/20 quarter. So again, long-term debt up another 2.7%. Compounding with that total debt number that we've been looking at. So the real issue here is that when you do a financial statement analysis, the total debt to assets and many of the other financial ratios are masking the severity of the long-term debt issue. And the idea is I want to explain kind of how this is happening. You can see here that when we look at total debt to assets, it doesn't look as though the airline industry is going to have that much of a problem. And why I'm saying that is because these COVID leverage ratios in aggregate, again, I'm just looking at total debt to assets here as an example for you. But if you do the analysis across the leverage ratios, you can see that they are higher than where they were coming out of the great financial crisis, but they're not so high as to be sounding off alarm bells. And so this is what I want to discuss a little bit more is take a look at how this is possible. How can we have that much debt and have total debt to assets and other financial ratios kind of masking the severity of that long-term debt load? And the answer is because of cash and cash equivalents. So the financing activity of taking on the debt has basically resulted in a massive cash influx to cash and cash equivalents on the balance sheet. And in the research system, under the summary standardized financials, all I did was literally click on the heading here, and you can see that we're actually charting that number, and you can see the magnitude of that cash increase. And again, this is for the ZRS composite, the big 4 airlines, so an aggregate of the big 4. And so this would obviously seem like a good thing until you actually dive into the statement of cash flows. And again, this out of the research system, one of my favorite views. I actually designed this view to be a nice comparative view, and you'll see the advantage of this view versus any others that you might have used in the past. In the top section, we give a reconciliation of the free cash flow adjusted after dividends. And you can see that obviously in 2020, we pretty much cut the dividend from what it was in 2019. And again, this is in aggregate across the big 4. This is a composite. And you can see now in trailing 12, we're down to a 0 dividend. But what I want everyone to pay attention to is the fact that we're burning cash at a tremendous rate. You can see this negative 6,974. This is actually in millions, okay, scaling. So these are big numbers. This is a massive, massive cash flow burn. And you can see that in normal operating times, again, on average for the aggregate of this big 4 airlines composite, these companies are running a positive free cash flow adjusted even after paying dividends. Now the dividends are cut, and we've got just this monstrous cash burn going on. So what we want to do is we want to focus on what has triggered that immense increase in cash on the balance sheet, even despite the airline burning this much cash. And it's coming from financing activities, right? I've already said that long-term debt issuance is literally driving positive cash flows for us from financing. So there's some distortions we got to look through. And that's the beautiful thing about this cash flow analysis view, is that you can compare free cash flow adjusted after dividends. So this is basically your cash flow that's coming out of operations after making adjustments for CapEx and dividends, depreciation, amortization, and other things. And so you can compare that to the actual statement of cash flow, right? So net cash from operations, another reconciliation of free cash flow here, and then your traditional net cash from operations, cash from investing, financing, and then ultimately change in cash and cash equivalents. So the idea is, how do we basically look at this information? And what I like to do is I like to, and again, this is not to be treated as, adding or subtracting any of these numbers. These are literally different reconciliations of changes in cash or free cash. So I have this free cash flow adjusted after dividends here. I like to look at this number and see that for the big four, we're actually burning cash. And even despite the fact that the change in cash is positive, I like to look at the source of that positive change in cash and make note that it's because of the debt financing that they've taken on, the cash from financing. So I've got the caption up here on the slide: watch for contributors to change in cash and cash equivalents. Look for red flags, right? This is obviously a red flag. We've got change in cash and cash equivalents going up, and we've got a massive, massive free cash flow burn. Okay, so that's a red flag that we need to look for. And then we want to take a look at what some cash flow catalysts might be that would point to signs of a real financial recovery. Obviously, what was discussed in the Wall Street Journal was very, very superficial. When you lift the hood on any stock or any industry, as we're doing right here with the big four airlines, you'd want to take a look at those same line items pre-crisis. And you can see, again, that free cash flow tends to be fairly positive here pre-crisis. Net cash from operations also positive, right? But you can see what happens as we go into COVID. These numbers get really, really negative, and obviously very large. And cash from financing, where you're normally paying down your debt obligations, now we're ramping up those obligations and contributing cash. Okay, changing cash and cash equivalents skyrockets. These types of changes in the statement of cash flow can really distort the financial ratios on the balance sheet. So this is what a recovery in the airline industry will look like. So look to your statement of cash flows from 2019 and 2018 to see what healthy net cash from operations and healthy free cash flow adjusted after dividends looks like for the industry. And you can see that here. And obviously you can do that on a stock by stock basis as well. Same thing with cash from financing, same thing with change in cash and cash equivalents. Okay, so the whole premise, obviously, of this webinar is, as the airlines prepare for takeoff, they're obviously burning a lot more than jet fuel, right? They're burning a ton of cash. And this is what we've got to keep our eyes on. And what I've done here is in Advisor Tools, I've actually charted the free cash flow adjusted trailing 12 months that we were just looking at. If I go back to the previous slide, that we were literally just looking at here for the big four in the actual financial statement. So this information is available in Advisor Tools in chart form. And I've actually done this for American Airlines, Delta, Southwest, United, Continental. And you can see that I've actually drawn a little red line here for the zero line. And you can see that coming out of the great financial crisis, the airline industry was in pretty good shape relative to cash flow, certainly compared to where we're at now. We've got potentially some trouble looming if we can't get the airline industry recovered quick enough. And again, we're looking at a three-stage recovery. It's leisure, it's business travel, and it's international travel, and that can happen in any order. And we need to keep our eyes on this free cash flow burn. It is real, and it is far worse than the great financial crisis, and no one's talking about it. So what does this look like from a composite perspective? Again, as these airlines taking off, if you look as they're taking off, as they're preparing for takeoff, and if you look at this as a composite, you can see that they're burning a lot more than just jet fuel. And again, this is their free cash flow adjusted composite out of the research system this time, showing in aggregate what this group looked like on an equal weighted basis through the great financial crisis relative to where we're at now with COVID. So obviously a much better financial condition for the airline industry coming out of the great financial crisis than what we're looking at here. So again, the airlines are really facing some difficult times in their financial recovery. And in many cases, this is something that they really haven't experienced in aggregate in the past. Obviously, a few of them have fallen into bankruptcy and gotten out of bankruptcy. But when we talk about the entire industry in aggregate, this is certainly something that they have not yet faced. So when we look at takeaways for today's webinar, and we look at this story that was published in the Wall Street Journal, again, pull it up from Friday. It was on the main page of the business and finance section. And if we look at this financial recovery, this is not a layup for the airlines, right? No one is talking about the debt load required to get through the COVID crisis. We're not through it. And but they will be talking about this soon, I can promise you. Total debt is literally 3 to 4 times higher with COVID than it was coming out of the great financial crisis. We looked at the financial ratios, and we looked at the cash that's still sitting in cash and cash equivalents on the balance sheet, which is obviously a good thing. But in many cases, when we're looking at financial ratios, leverage ratios, coverage ratios, anything like that, that cash and its source can actually be masking some of these issues, which is the free cash flow burn. So just keep that in mind, that while the airline industry is looking good right now from a coverage perspective, they got plenty of cash, they're burning it quickly. So we've got to get through this COVID crisis in fairly short order. So the cash flow burn, specifically the free cash flow burn, it is real, and it's definitely the largest risk as these airlines are trying to determine when specifically business and international travel is going to return. I think that the article did a pretty good job of laying out the fact that leisure travel is already being forecasted to return, but the big unknown is that business and international travel getting back to pre-COVID norms. So again, recovery in 3 stages. Watch for the recovery in leisure, business, and international, and then look to that statement of cash flows. Look, I get it. Statement of cash flows, that's confusing. Most financial advisors, and there's a lot of portfolio managers that don't even understand how to analyze the statement of cash flows. It's fine. If you guys have questions, shoot me an email. More than happy to review any of this with you. That's not a problem. We can go through it. So look to that statement of cash flows as your first sign of financial recovery. Look for positive change in cash, driven mainly by that positive free cash flow adjusted, and look for positive net cash from operations. Those are basically your 2 canaries in the coal mine for determining when that turning point is likely to begin for real in the airline industry's financial recovery. So that's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn. I'm also on Twitter @TimNyland. If you're interested in getting started with Advisor Tools or ZRS, or if you're looking to upgrade your current subscription, or you just want to talk more about the statement of cash flows, if you'd like a copy of my deck, just let us know. Contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you for watching, and I'll talk to you next week.